Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Before we get into today's episode, don't forget, Trish Regan is now a part of the Stansberry family. Check out her podcast, American Consequences with Trish Regan. The link will be in the description of this episode. In today's episode, we'll talk with Chris Mack, a portfolio manager and analyst with the firm Loevner. He's a very thoughtful, very rational guy, and I can't wait to talk with him. This week in the mailbag, you finally did it. You sent me more emails than I could read. The only thing I won't comment on is Bitcoin because we got way too many emails about that, but I'll talk about everything else. And in my opening rant, I'll give you my 10 surprises for 2021. That and more right now on the Stansberry Investor Hour. Happy 2021. Let's get to it. Okay. Now, I'm going to tell you what each surprise is, and I'm just going to give you a little quick bit about it, and then we're going to move on to the interview. Okay. What I hope to do is revisit these maybe in 3, 6, 9, 12 months, whatever. We'll definitely revisit them in 12 months, but maybe we'll revisit them before that as they either obviously come true or obviously don't come true, okay? A little different than what we did last year. And I'm not going to spend near as much time telling you the surprises this year, right? We're just going to get to it. All right, surprise number one, I think it would surprise the heck out of everybody if the S&P 500 dropped more than 20% in a single trading session. Anybody who knows about this knows that that's impossible, right? They close the exchange if it drops more than 20% in a single session. How can that happen? My point here is that I don't think these people have as much control over this as I thought they did, as everyone thinks they do. The Fed doesn't control the market. The Fed doesn't control the bond market or the stock market. And the people running the exchanges could find themselves in a situation where the market drops faster than they can close the exchange. Yes, I do think that could happen. Overall, I don't think mankind has the kind of control over nature, including markets and societies and economies, that a lot of people believe today. It's the great fallacy of our time. Surprise number two, the S&P 500 hits new all-time highs and breaches the March 2020 low this year. Higher highs, lower lows. That's the definition of what? Well, it's the definition of volatility. That's the point. But it's also that wider range of outcome is the definition of risk that we keep talking about. And that would surprise the heck out of everyone, right? I think it really would. Surprise number three. Okay, the economy continues to recover and stocks correct sharply. What did we have in 2020? Well, the economy got bludgeoned and the stock market, corrected and then took off like a rocket ship even as the lockdowns continued and news from various economic sectors was dismal. I mean, it improved throughout the year, but dismal. And I'm just saying it can go the other way. The news can get better and better all this year and be really good. And, the stock market can still crash. Surprise number 4 for 2021. Tesla falls more than 50% and gets kicked out of the S&P 500, right? Tesla's in the S&P 500. The market loved that. The thing has a $700 billion market cap. $700 billion, it doesn't even make 500,000 cars a year. GM and Toyota together make something like 17 million cars, like 34 times Tesla's output. And their combined market cap is less than $300 billion. Tesla's like 2.5 GM plus Toyota. It's insane. It's ridiculous. I think it would surprise the heck out of everybody if this stock, which is practically a 5-bagger, it's insane, just insane. Or actually, I'm sorry, it was more than a 5-bagger. It's a huge multi-bagger for 2020. And it would surprise the heck out of everybody if it crashed. Surprise number 5, Bitcoin. What the heck would surprise us here? Well, it would probably surprise a lot of people if it didn't keep going straight up like a rocket ship. So if it went sideways or down a whole bunch, that would surprise a lot of people. So we're at around 35,000 as I speak to you. And, I think anything under about 17 or 18,000 would really surprise a lot of people. And it would surprise me if it was like 200,000 by the end of the year. It really would. I don't think that would surprise a lot of people, but it would surprise me. But the big surprise for everybody in Bitcoin is falling a bunch, right? Falling about in half. Surprise number 6, the VIX makes a new all-time high. People are in love with stocks. Volatility fell. It spiked up to a new all-time high in 2020. So I think it would surprise the heck out of people if in the very next year, it hit another new all-time high, right? Folks like Christopher Cole, who we had on the program, probably the biggest, volatility expert before the public today, and another very thoughtful guy I like named Mike Green, they're looking at what happened in 2020, in March 2020, and saying, oh no, that's not the big event. That's not the big, crazy, volatile event I'm talking about, okay? So smart people are in the same camp as me here, potentially. Surprise number 7, bonds stop protecting you from losses in stocks and just do lousy in general. As I speak to you, bonds are kind of getting whacked. Treasuries are getting whacked as election results from Georgia come in. And, the thing over the past 2 decades especially has been, well, when your stocks do lousy, your bonds protect you. But over the very long term, many, many decades, that wasn't necessarily always true, and it could not be true again. That's surprise number 7. Surprise number 8, 10-year U.S. Treasury yields either 0% or negative or 5% or more, right? So Treasuries either soar or prices get whacked and yields surge up. I think people are generally comfortable in this range between 1% and 4%. Now, certainly with the 10-year right at 1% as I speak to you, surging quickly up to 4% would be, whoa, that would be a huge, I would probably do a victory lap at that point, even though I said 5% or more, because any huge surge up in yields, I think, would probably surprise a lot of people because people believe the Fed controls these things, right? Next, surprise number 9. The FANG stocks rise another 30% and then erase all of their 2020 gains. That would surprise you, wouldn't it? To see, Facebook, Apple, Amazon, Netflix, Google, all this stuff crash back to whatever it was in, say, like 2019. I think that would surprise a lot of people. And surprise number 10, COVID lockdowns continue until September or longer, through the summer into the fall or longer. I just had this sneaking suspicion that, you know how I feel about government in general, right? They like locking us down. They like controlling us. And I think they like it in a pathological, sort of insane way, a lot more than the average sort of, person will admit. I think the average person who votes and thinks our system is great, which actually it is compared to all the others, would say, oh, no. They don't hate us that much. It's not that they hate us. They just like controlling people so much. And that's why they got into the thing, the government in the first place. So those are my 10 surprises for 2021. 10 things that I think if they happen would be big surprises to investors based on what is in the news and what is in the market right now. They're not predictions. They're things that I think would surprise the heck out of you. And I admit that when I went over my surprises for 2020 and when I did them in the first place, I didn't make it clear why I was doing this. I'm doing this to identify stuff that's not priced in right now, that people would just really are not expecting. So I'm not predicting it would happen. I'm just saying it would be a big surprise if it happened. In some of these things, it's a way to identify risks that aren't being priced in, right? Nobody thinks Tesla's going to fall 50%. Nobody thinks Bitcoin's going to fall 50%. Nobody thinks the COVID lockdowns are going to continue for most of the year. You see what I'm saying? So these things would be surprises. That's the point. The point is to pull you outside of the box that we all live in, and I live in the same box too, right? I get comfortable just like everybody else. And to identify what the heck would surprise you. All right, my quote of the week is kind of long, so I'll just get straight to it. It's from Jeremy Grantham of the firm GMO. And he says, the long bull market since 2009 has finally matured into a fully fledged epic bubble, featuring extreme overvaluation, explosive price increases, frenzied issuance, and hysterically speculative investor behavior. I believe this event will be recorded as one of the great bubbles of financial history, right along with the South Sea Bubble 1929 and 2000. These great bubbles are where fortunes are made and lost and where investors truly prove their mettle. For positioning a portfolio to avoid the worst pain of a major bubble breaking is likely the most difficult part. Every career incentive in the industry and every fault of individual human psychology will work towards sucking investors in. But this bubble will burst in due time no matter how hard the Fed tries to support it, with consequent damaging effects on the economy and on portfolios. Make no mistake, for the majority of investors today, this could very well be the most important event of your investing lives. Speaking as an old student and historian of markets, it is intellectually exciting and terrifying at the same time. It is a privilege to ride through a market like this one more time. And that's Jeremy Grantham from a piece he put out recently called Waiting for the Last Dance, The Hazards of Asset Allocation in a Late Stage Bubble. I got nothing else to say. I'm just going to let that stand. Let's go ahead and talk with Chris Mack right now. My colleague and friend Dave Lashmet is on fire right now. His average closed pick this year alone has returned 187%, almost triple your money. Today, he's got a time-sensitive $13 stock pick that he believes is set to explode. This is an opportunity you don't want to miss. Listen to Dave's take along with all of his evidence on the stock over at investorhourtech.com. Check it out. All right, it's time for our interview, our first interview of 2021. Hey, and today's guest is Christopher Mack. Christopher Mack works for Harding Loevner. He's been there since 2004, and he works as an analyst in information technology. He's also a portfolio manager in their global small companies, global equity, and world equity strategies. Maybe we'll find out what he does with all those strategies. And he's also a partner. Chris, welcome to the program, sir.
Thank you very much. Appreciate you having me. And I guess Happy New Year.
Yeah, Happy New Year. So I think my first question for you has to be my first question for just about everybody in your business. How old were you when you knew that this was going to be your career direction?
Yeah, it's an interesting question. So I guess if you go back, you probably get a sense of my background. My first passion, I guess, was technology. And then, so I guess you could say I got caught up in the 90s with, the tech bubble and whatnot, and getting very interested in markets at that time. Like a lot of tech people back in those days, you thought, oh, you know what? I'm going to be the next Bill Gates. I'm going to develop my own software, come up with my next company, and become a billionaire. It's going to be that simple, right? And then somewhere along the line, you realize, okay, I started paying more attention to how markets work, and why suddenly, tech wasn't as valuable as it was, for example. Why it's harder to do all these types of things. Why are the stock market down? And so just from there on, so I would say probably my real interest started to grow basically right out of the tech bubble, which is just trying to see where the opportunities were after that major sell-off. And just going from there.
I hear that a lot from folks who are maybe like, roughly in their, late 30s, 40s, maybe even 50s, some of them. They say, yeah, I got into the tech bubble and it didn't work out, but I was hooked. which is sort of interesting to me. It's interesting to me, and I don't know if you have any comment about this, but isn't it interesting that people say, yeah, I got involved in the tech bubble and it crashed and I lost a lot of money, but I was hooked. How do you explain that? I mean, it's sort of strange, isn't it?
Yeah, to some degree, I guess you could say it's just a part of the fascination with markets, right? And it draws us all in. And I think there's a bunch of behavioral aspects that get into us, whether it's the gambler, like a gambler mentality that could come into it, the desire for reward that can come part of it. But overall, I think for me, it's just just understanding why things are happening the way they're happening. And so in that case, going back to the bubble, it was, okay, why did, suddenly everything was supposed to be the game changer, right? And then suddenly it wasn't. And that the truth was somewhere in between, right? It wasn't that, okay, yeah, sure, pets.com wasn't going to be the next great business, but there had to be something out there. And maybe it only took 15, 20 years or so, maybe, right? Let's think about the pandemic this year and, acceleration of e-commerce and everything else. The groundwork came from that, right? And so I think there's a lot of opportunity to be had if you could harness your emotions, take advantage when people are too optimistic or pessimistic, and and invest on a longer term view. So that's the opportunity. I think, to me, that's what excites me.
So are you feeling here in January 2021, are you feeling overly optimistic or overly pessimistic or somewhere in between?
So I'd like to say it's somewhere in between, because that would follow on what I just said, right? That I'm trying not to be too optimistic and too pessimistic. But being the new year, I think we all feel some optimism. I think the interesting thing is there's always a reason to be optimistic somewhere in the market, and to not just look at the market. And I think when we've seen what happened with tech in this past year, there's obviously a lot of optimism that's in the tech segment of the market. And so it's easy to be probably a little bit more pessimistic sometimes there. But, when you think about the longer term potential here, some of the acceleration that's happened in technology, there's reason for longer term optimism. Shorter term, when you think about valuations, you could certainly make a case that at least segments of the market have gotten to be too optimistic, whether it would be, I think anything that had a name cloud in it did perform very well last year. And I think be a longer term positive, but 2021, I don't know. I think the thing that is on my mind is really, just like a lot of people, just trying to figure out, what does the vaccine mean? What does return to new normal mean? And so one of the things that I'm thinking about, maybe it's kind of related to, 2020, 2021, New Year introspection, that type of thing, which is what consumer habits formed over the last 12 months or so that will stay, and what will be, what are permanent changes, or what are things that we're just going to revert and go back to doing it. And so I think it has a lot to do with, where segments of the market, certain ones will do better than others, depending upon your point of view there. Does that make sense?
Yeah, it does. I mean, I heard what you said about not wanting to be too optimistic or pessimistic, but at this moment, the stocks have kind of gone, well, everything just about has gone ballistic. So I'm sort of poking around to see, kind of exactly where you're optimistic and where you're pessimistic. And you're telling me you're trying to figure out. It doesn't sound like you've maybe completely figured it out, or maybe you have. Have you figured out like what you think are the permanent habits that were established over the past year, and which ones are maybe going to go back to the way they were? Where are you in that process that you just sort of described a little bit?
Yeah, I would say it's an ongoing one, but but it's one of those things that I would say, at least if you were to think about what's implied in some of the stock prices, I think it was. It seems easy to say now in retrospect that, okay, earlier in the year, that whole mean reversion kind of idea, the fact that people will go back to travel, maybe oil prices would go up, those types of things. It's not probably completely in the price. I think there's more room for that. That could still develop throughout the course of the year. So I think what I'm focused on is looking for the other side of things. So, for example, the market jumped really quickly in November and said, okay, everything is suddenly going to go back to normal, right? And the vaccine will get rolled out and no problem. And now you look at here, we're sitting here in the beginning of January, and this talk of the market is, hey, the rollout hasn't gone quite as quickly as everyone had anticipated. And oh, by the way, there's a new mutated form of the virus that's spreading like crazy in the UK and it's other places. And so now the market has kind of tempered their optimism. So for me personally, it's being selective as to what you think. So I think Amazon, that's one that's kind of a consensus one. But I think there's certainly new customers that they're acquired that they will keep. But to me, there's other opportunities in other areas that are non-Amazon. So, for example, a company like Etsy, which got put on the scene because of a lot of the homemade masks and the homemade goods that it provided, and mask sales in particular went up. If we had this conversation last year, and I'm telling you about mask sales, who would have thought, right? It just goes to show you that the 2021 predictions and what they're ultimately worth. But that's an aside. But to me, that's another one where maybe they've acquired new customers, and they show, interestingly to me, they actually break out the data in terms of their consumer behavior, and very helpful. They break out the mask demand, what they call the pandemic, maybe one time, things that are not going to go on forever. But they've been very successful in converting customers to be repeat in other homemade goods. And so to me, that's interesting because it sort of tells you about the non-Amazon online world, right? Everyone all the time thinks Amazon and e-commerce is going to eat everything. But I think what we've seen with the pandemic is just the acceleration of more traditional retail type of shopping into online. And Etsy is one way of harnessing that, because they produce things that you would find in your local store, maybe homemade from, as opposed to something that has a product SKU that you find every place, Walmart, Amazon. It's a commodity type product, right? And so to me, that's just one example of that. But I'll just maybe give you one more, one that I was wrong about, which was a company, a smaller retailer in the US, Five Below, where I thought, okay, you know what, acceleration of e-commerce, this has to be bad, for this in between, right? They're not a dollar store, they're somewhere in between. But and this kind of gets to consumer habits. I think, when you look at what the data, consumers, as soon as the stores reopened, went right back. And it shows you that they have something differentiated there. It's hard to do, but they have it. And so those are just a couple of ideas that I've been sorting through, and these are ones that we own.
Oh, so you do own Five Below now?
We do now, yes.
Yeah. Okay.
Oh, that's in the smaller company strategy.
Okay. Yeah. So, hey, maybe tell me about these different strategies where you're a portfolio manager. Global small companies, global equity, world equity. What's the difference between global equity and world equity? What does that mean?
So by the definition, at least as far as MSCI is concerned, global is across the world, and world basically is everywhere except the emerging markets. So world strategy will not have emerging markets involved in it. And it seems like a quibbling between splitting hairs, but that's the way it's defined.
So what's your personal? I've heard a few folks like Jeremy Grantham, the folks at GMO, and maybe a couple others who are thinking like from this point forward, emerging markets probably outperform the U.S. Do you even have a view like that, or do you not bother with it?
We won't typically take a top-down view necessarily. I think what we try to focus on here is looking at the world through the lens of the companies that we own and we pay attention to on a bottom-up basis. And what are they telling us? What's happening? And then, comparing notes between all the companies and seeing which management. You always have to be somewhat cautious about management commentary that they're talking their book. But if you compare across companies and their peers, you will get a good sense as to what's happening. And so in the case of emerging markets, if you just look at if you take the top-down perspective, there's some demographic opportunity depending upon where you look. And so, for example, one area where we do have a little bit more of a demographic focus is in financials, where we think that that's the longer term opportunity. Banks in the emerging markets, for example, where credit is less penetrated, there's always going to be cycles that you have to worry about. This is, the economic cycle, despite the efforts of everyone in the past 10 or 15 years, they don't go away. They only they just change differently, right? So in EM, banks are a good opportunity, but the interesting one that is a source of that's very topical these days is technology, and technology, particularly in China. And obviously, there's been a lot made between the U.S. and China, and tech and arms race, and what's going on there. But without getting into all those details, certainly China has got, by the population, the largest internet connected population in the world. And so that brings you to some of the obvious ones like the Alibabas, Tencent, and so on. So for us, when you look at emerging markets, it's about the banks, it's about technology mostly, and generally speaking, there's opportunity there. At least in banks are pretty inexpensive compared to the rest of the market. Tech is a little bit different. It depends on I think the thing in China, you worry about now the increased risk of regulation there, not just about the trade war and everything else, or maybe the easing of the trade war. It's about what's going on in China. And, to what extent they're now imposing more restrictions on, say, Ant Financial, for example, with the lending platform online that they've developed. And so longer term, I think, though, the opportunity is still there.
Right. So it sounds like you don't wring your hands about the fact that China's still a communist country. It's a command control economy. You're just looking at what is happening in individual industries. You're more sort of bottom up that way. Do I have that about right?
That's right. But I think you bring a good point. You can't view everything in isolation. You have to have a perspective on the region that it's operating in. If you're a global business, say if you're Alphabet, Google, Facebook, all those, if you are those companies, you're globally diversified, except for maybe having China, right? And so you could say, okay, if the regulation in one particular market gets worse, okay, you have some benefit of coming from some other area where maybe the regulation won't be so bad, or there's more diversification that could come from it. Obviously, if you're investing in Alibaba, they've expanded their footprint into the Southeast Asia quite a bit. But overall, right, you worry about what's going on in China, the rule of law, what can happen, and so on. Coming back to the idea, though, of habits, right? I think just like how right now we are very accustomed to, Google searching through Google, right, on the internet. It's just sort of a habit, right? It becomes a verb, all those kinds of things. E-commerce or shopping in China, for example, is a habit. Alibaba's got the dominant platform in e-commerce of the habit. So they may be more regulation there, what have you. But at the end of the day, it's a very powerful platform that is, consumers are not going to stop shopping because the government is worried about maybe Jack Ma challenging regulations, right? They're going to say, this is convenient and this is good. This is a good service. It delivers it on time, delivers what I need. And I think ultimately those are the types of things, to your point, bottom up, that we're focused on.
I see. Okay. Chris, I hope you don't mind me just sort of jumping around a little bit. I want to talk about your firm, Harding Loevner, just, give you a chance to tell us what you guys are about and a little bit about your philosophy and process and stuff. But I have to tell you, this one quote on your website where I've been looking around, it really caught my eye because it reminds me of other firms. And it's by your director of research, Yoko Sakai. She says, we want our clients to benefit from the healthy debates that we have amongst each other. And then elsewhere, there's a little bit about collaboration without consensus. So this sounds like an interesting dynamic, and it vaguely hints of Ray Dalio and Bridgewater and everybody being, very openly, I forget his phrase for that, but everyone's very brutally honest with each other. I don't know. What's the feel around the office? How does this play out, day to day and overall? What's it like at Harding Loevner?
Yeah, it's a good question. So, Yeah. So collaboration without consensus, that's sort of our tagline. We're very focused. I think the other thing you might see on the website, or we may have changed it a bit, we would post and say, humans aren't by nature meant to be good investors. And that's kind of an interesting thing, right? If you're an active manager and you're telling people that, humans aren't meant to be good investors, okay, then why am I looking at you? But it kind of gets back to process and trying to have good habits. So one of the things that we worry about a lot is just making sure is bias, making sure that we are not missing out on something just because of our background. And so what we've tried to do, so just stepping back, we're focused on investing globally, building portfolios diversified across the world, and we're focused on the quality portion of growth. So we want to make sure that we think on a longer term basis. We want to invest in growth companies. That gives you the best opportunity to outperform. But importantly, they have to have quality. It's not just, pie in the sky. Eventually, one day we'll make money and it'll get figured out. Although we think about those things too, but we're much more focused on companies that have got good financial strength, because just like we saw in this past year, you never really know what can happen. And so, for example, if you are a business that's highly indebted, not making a lot of money, the pandemic hits, and you have this great idea for the future, but if your company can't get to tomorrow, it doesn't matter, right? And that's a great idea, but that's lost money for us and our clients. So we want to make sure they have that financial strength, so that when we know to expect the unexpected, and so that when that happens, our companies that we invest in have got the strength that they could emerge from it stronger, and that gives us the confidence to be disciplined. That when the market is selling off, okay, you know what, is the investment thesis of growth on track for this business? Yes. Okay, the share price is 20% cheaper. Let's go and buy. So that's the overall philosophy of what we're trying to do. The process in which we execute it is this collaboration without consensus. And as I said earlier, it's about trying to minimize bias. So we've tried to hire a globally diversified team with people who have lived across the world, grown up in different parts of the world, different backgrounds, people like me who have more of a tech background, others who have backgrounds in other areas. So we're really trying to harness cognitive diversity, not just based on our own individual experiences, but also our professional backgrounds, our educational backgrounds, and so forth, with the idea that we're all requiring each other to communicate in written form. And that's one of the things that's different. So when I have to write about something, I'm writing about my idea and I'm sharing it with all of my colleagues. And immediately, the idea is to get instantaneous feedback. And it's up to me. So I just want to maybe make a distinction here that we operate as a team, but we're not required to agree on everything. And that's one of the things that we think is really important, because, if we all are all part of a team, let's say you and I are part of a team, and it's my job, we have to come up with some consensus perspective as to what to do with our portfolio. And I'm trying to convince you. And so what am I going to try to do? I'm probably not going to stick my neck out too far, because I'm going to think about what it is that you like and go with that, because I know you'll agree and I know we'll do something. But that may not always be the right thing. And so ultimately what we're trying to do is get the benefits of collaboration, which is, hey, I'm getting different perspective from, that I didn't know, that they're giving me an idea about the risks and opportunities that maybe I didn't fully appreciate. But then at the end of the day, it's up to me. I make that decision, and that decision gets put forth, and it's those signals go out there, and hope, over time, the whole idea is that it leads to more effective decision making repeatedly over time. That's probably a bit of a long-winded explanation, but does that help understand?
Yeah. Oh, don't be afraid. It's not long-winded at all. It's thorough. And I like that. I like to ask questions and let my guests really tell me what they're thinking. So yeah, absolutely. So let's talk about, we talk about just the difference between the global and world strategies. And I also noticed that your list of stuff that you do at Harding Loevner says you're a portfolio manager in some of these strategies, but you are like a technology, it seems like, analyst, information technology analyst. So I guess what I'm ultimately asking, Chris, is what the heck do you do all day? Does that mean that you are the information technology guy for those other strategies, or what? How do just tell me like about your role and all the stuff you do at Harding Loevner.
Sure. Yeah. No, it sounds like a lot. As far as technology, so all portfolio managers at our firm are also analysts. And so for me, my specialty, if you will, is in technology. So I focus. So one of the things, just to get back to that process idea, where analysts are in charge of their sectors. So for me, I am looking at the ideas in technology. I'm trying to focus on the best quality and growth opportunities within that segment of the market. And then that research that I produce gets, in a way, consumed by me as a global portfolio manager, but then also to our other portfolio managers on the strategy. And that's a good way for really exercising individual accountability, because you're wearing both hats, right? So when I interact with other analysts, it's a good back and forth, robust debate. They'll look at what I'm doing as an analyst, and then they'll look at my portfolio. For example, we publish our portfolio, and it's pretty transparent to everyone. And so it creates good dialogue to say, okay, if you like this in your technology sector, why is it owned in a portfolio, for example? And so one of the things we're trying to always look to do is to try to find ways to identify signals, and really look for consistency when you're having insights, right? So if I say software is a great place to be, okay, let's look at the portfolio. Is it in there or not? Why or why not? And so we have that. So for me, what I do in my day, I focus on technology as an analyst, and then I look at the rest of the world as an opportunity set. Fortunately for me, we narrowed down our universe pretty finely down to about roughly 500 stocks that we cover across the world that we think meet our key criteria of companies with sustainable competitive advantages, financial strength, good management, growth, durable growth, and we focus on that. But we also pay attention to what we don't pay attention to. But our primary focus is on those 500 companies, so that makes it a bit easier. We're just trying to streamline things a bit to separate the noise from signal and just look at the things that we're really worried about.
So how do you add to and take out of the 500 companies? There has to be a process for that, right? It's got to be constantly changing to some degree.
Absolutely. Yeah. And that's probably the thing that we worry about the most, especially when we talk about our longer term view, our typical holding period is about 5 years. And so over that time period, there's going to be a lot of things that happen. And so what we're really trying to do is say, okay, in order to look at all these stocks, you have to try to separate that signal from the noise. What's the most important thing to the fundamentals of the business, the growth thesis that I'm laying out as an analyst? And so we call those mileposts, with the idea that I'm going to come up with the 3 to 5 things. What are the most important things that are going to happen here that are critical to making my model work, right? What has to happen? Do margins have to go up? If you're expecting margins go up, what's the reason for that? You're trying to get to that underlying thing. So when you do that, it's incredibly hard to do, to come up with those 3 to 5 things. And sometimes we're wrong, to be quite honest. And when we're wrong on those 3 to 5, those mileposts, when things are failing, things are not living up to expectation, then they'll leave the universe. The investment thesis didn't work. This is still a business where if you get anywhere near over 50% right, you're doing a good job. And we always strive for better. We've been fortunate that our hit rate tends to be somewhere in that 56% range over a longer term perspective, but we're always trying to drive that higher. So name stocks that go in and out of our universe is based on our interpretation as to what the fundamentals are, what's happening with the fundamentals, what are the key reasons for owning it intact. This gets me to say some of the behavioral aspects here that we worry about. The endowment effect, which is, okay, we own, when there's been scientific studies that show if I give you something, you start to value it more than if you're looking at it owned by someone else. And so you want to be careful that you want to be disciplined that, okay, if a thesis isn't working, time to sell it out of the portfolio. Forget that you own it. Pay attention to the key objective. They're missing their mileposts. Time to sell, get out of the portfolio. And then pay attention to the opportunity cost, which is, okay, what are the 500 stocks that we cover? What else don't we cover? Because what you don't own can also hurt you as well, right? You could miss opportunities that way. And so we try to be objective in looking at the rest of the world, looking at things like, okay, which companies have sustained profitability, which companies have sustained growth, which companies have good management teams, and so on. And so those will filter in as we continue to do our bottom-up research.
This is going to sound crazy, Chris, but the thought in my head right now, as you answer all these questions, you sound like such a rational, reasonable, thoughtful guy who's really trying to not go too far in any wrong direction. And I think my wife thinks I'm that way too, and it drives her out of her mind. Are you married? And if so, do you drive your wife nuts with this?
Yeah, I think the honest answer is yes. And she'll probably listen to this and hear it. And I think that's pretty cool. So yeah, no, I think that's true. And I don't know, I wish I could, maybe you could help me understand why you think you're the way you are. Because I tried to understand it for me too, because it just in some ways seems natural. And kind of getting back to my background, Harding Loevner has had this process in place thinking about some of these behavioral things for a while now. But we were, at the time I joined, we were still building that out. And it was kind of, when I met the team, it was sort of like you didn't realize what you were looking for at the time. That, like, this was always in me. I've always thought about decisions that way, like whether it's like buying a new computer or something else, just trying to be very calm and, rational about things. And so it's been a good match. I'll be curious to know if you know why you are the way you are.
Well, for me, it's the other way around. I was always a sort of, I don't know, flatteringly, I'll call myself an intuitive and probably an impetuous kind of person. And I wasn't in great, financial shape and career shape, like into my mid-30s almost. I studied music in college, right? And I was just kind of running around Baltimore where I grew up and playing gigs here and there. It was kind of a bohemian existence. Then I had this big seminal event in my life of a back injury that sort of had me down for the count for a whole year, and I eventually wound up having surgery. So I had this big period of time when I was doing not much else but trying to get rid of pain and thinking about my life. And I thought, I think I've been going about some of this all wrong. And I remember after I had my surgery and I was doing better and doing therapy and stuff, I was sitting on the edge of the bed at my parents' house where I was, rehabilitating and convalescing and stuff. And I thought, I think I need a real career now. I think I need a real job. And just saying that, and I had been interested in the market, I had been interested in investing, and I had read like The Intelligent Investor and a couple things. So I just started down that pathway. And once I started down that, I quickly saw that my habits of impetuousness it had to be reversed. And I think the thing that drives my wife nuts is that when fancy yourself a rational thinking person, you think about something and you look at it and then you act. And you can reverse your decision in a heartbeat. And that just doesn't make any sense to her. She wants to talk about everything. And the bigger the decision, the more she wants to talk about it. And she wants to move back to, we live in Washington State. She wants to move back to Oregon. And like, she wants to interview a bunch of real estate agents. And I'm like, I don't care. They're a bunch of salespeople. They're all the same. I don't care. And that drives her out of her mind because I have this view. I made up my mind. It's like the faster you make up your mind, the more your wife is going to hate it, That's part of it is for me is that,
Yeah. No, so I think for me, I've always grew up out for whatever reason. I've always been appreciative of history. And my dad was a history major, and I've always just enjoyed history. And for me, I think it's there's always some lesson to be learned. And one of the things, if you go back into like just my early experience with investing with the tech bubble, is just realizing, right, that the famous phrase, right, Greenspan's famous phrase, the irrational exuberance. And you start, I think a lot of it comes back to that, which is sort of the realization that, if you have to, you're when it comes to decision making, you could be your own worst enemy. I think you touched on that with what you just said, which is you have to realize there's good instinct, your gut, right? Which is when you see something, you realize something could be big or very different. You have that initial, and your instinct could take you a good part of the way. But if you're not careful, it could dictate things and you could get too excited about things. And so you have to just remind yourself to be grounded, which is really hard, right? And especially when if you want to look at like, I guess the equivalent of the tech bubble now is whether it's in, Bitcoin or some of these special purpose acquisition companies, those, with some of the recent IPOs, no one wants to see your neighbor get rich, right? And that's what you bring up conversation with your wife. No one wants to see that, right? And so it's just kind of an interesting thing to think about, just how to harness your emotions to make good decisions. Because at the end of the day, that's what this is about. It's, yes, you want to get some stocks right, but to do it over and over and over again, you have to have some decision-making process that gets it right. And without that, you're just kind of throwing darts, and we know what that looks like. So.
Yeah, we talked about this with Jack Schwager, the guy who wrote all the Market Wizards books. And the weird thing, like, we're human beings. We can't get away from our emotional nature. You simply can't get outside of it. You're always in it. And yet, like all the great traders, except for one, there's one exception, they all say, I try to keep my emotions out, at bay. I try to keep them out of the way. I try not to let my emotions influence what I'm doing. And there's only one guy, a guy named John Netto, who says his emotions are very important and he uses them often, as a contrary indicator, for example. You sound like you fall into the camp where, me and all these other traders and Schwager and everybody else is, right? You're trying not to let your emotions carry you away, correct?
I think that's generally true. But I think you bring up an interesting point, though, about that one individual where, trying to use it as a counter indicator. I think that's when it comes to investing, everyone is different. People in general have their own different personality traits. And so what may work for me may not work for someone else. You could try to encode things in the process to try to minimize the known biases that are out there, the bad behaviors. The market's down a lot. I'm looking at stock prices and I'm just going to, I'm giving up. Like, that's it. I capitulate. Like, the pain is too much. I'm going to stop. Those types of things. You could do your best that you can. But at the end of the day, it's a very personal thing. It's about figuring out what works for you, what tendencies that you have that are either, good and you want to replicate that, or, what destructive tendencies you might have. And for us, I think a lot of times, given our longer term focus, it tends to be more of that endowment effect, which is, you start telling stories about a stock that you've owned for a long time. And the more stories you tell about it, then the more you start to love it even more, right? Because I'm telling all these people about it, and now I've told a story, it sounds really good, and now I'm really emotionally attached, and it's done so well for me over the years, it makes it even harder to part. And so for us, I think that's what for me personally, and us as a firm, that's what we struggle with probably the most.
Yeah, it's tough. And you actually alluded to something else. I've been telling people a lot over the past maybe couple of years that investing is very personal. And you mentioned that, everybody's different, right? That's got to make a business like yours kind of tough, right? I'm guessing you have clients, you have to deal with what? Hundreds of different clients. And maybe if you manage for an institution, 10 or 20 people in that institution or something. I mean, that sounds hard to me. I think that's one of the reasons why I'm not in that business. I tried to be in it, and actually that aspect of it didn't bother me because I didn't deal with that many people and they all knew me. But I would think once I got to 50 or 100 clients, all the different personalities would drive me nuts. You must have some extraordinary people who are in charge of dealing with clients.
Absolutely. Yeah. And I think a lot of it, my job is made easier by the fact that we are upfront with our clients as to what they should expect. And so we get into interesting debates where we're focused. The way clients tend to think about things, they divide their allocation into different aspects, right? So sometimes they look at a regional allocation. How much am I going to be in the U.S.? How much am I going to be outside the U.S., emerging markets? And they'll look at us that way. And then there's other people that are looking more at growth versus value. That's another segment of the allocation question. And so the question we're getting right now, given how well growth has done, which is, okay, now we have two different types of conversations with clients. One is, yeah, we know growth is expensive, but we're paying you, we're trusting you with our money to be invested in this segment of the allocation. And even if it goes down, we know this is the part of the allocation we want devoted to growth. Don't deviate. Don't deviate from that style. And then we'll have another conversation with a client that says, well, aren't you going to try to worry about the valuation and maybe lower that risk now that growth is looking expensive? And maybe, what will you do to manage that? Will you look at more cyclical businesses, or will you look at some other things that are not growth? And the key thing with anyone in this business is to be very clear and transparent with the expectations and what we're trying to do. And so we're always going to be committed. My job is made easier by being clear that we're going to be committed to quality and growth, irrespective of what the investment fashion is in style. And sometimes that means you're going to underperform. So like at the end of last year, the market liked more value. It liked more, lower quality businesses without as much profitability. But in a longer term view, it's been right. But you always are worried about that. But for me, it's, if you think that this is the right way to do things on a longer term basis, and you're transparent with your clients about that, and you're disciplined and you stick to it, that's the key, right? Getting back to behavioral stuff, the worst thing you could do is try to chase the trend and reverse at the wrong time. Okay, value is up, growth is up a lot, let's chase it, and then just in time for the style to shift. And so what we've done, we acknowledge that we're just not good at it. Just like predicting macro, we're not good at it. But we do know how to analyze companies, understand what they're doing, what their strategy is, where they operate. And so that's our advantage. And so someone else may have a different advantage, but for our clients, they tend to believe in that we have that advantage of this process of way of doing things. And so I think that makes the conversation a much better one.
Chris, a lot of stuff that you're telling me, from being really transparent and crystal clear with client expectations to these four attributes of durable competitive advantage and financial condition and durable growth and stuff. All of this there's a powerful whiff of Warren Buffett in all of this.
Yeah, no, I think there absolutely, and I think we certainly pay attention to all the good investors out there. There's always something that you can learn from everyone, right? And so Buffett for sure is an influence, and at least in terms of philosophically as what we're doing. It's not just the Benjamin Graham school. It's the Buffett school, right? So if we're looking for growth companies and realizing that, okay, it's not just fishing in things that look cheap. It's about what that, companies that could sustain growth over time and compound, and what that will ultimately look like over the long term, because we know that I'm not going to be able to predict next quarter. Maybe I will, but I don't have skill there. But if I can identify a bottom-up structural growth opportunity and a company that's best positioned to be there with good management that's got the financial strength to invest around that moat, you put all those things together, and it makes being 5 or 10% off if I'm lucky, my fair value estimate makes that look like nothing, right? Over the long term, that's going to be a very powerful thing, and generate returns for our clients.
Okay, yeah, cool. All right, Chris, we've actually been talking a long time. I've got one more question for you, and it's the final question I ask all of our guests. Same final question. If you could leave our listener with just one thought today, what would it be?
Oh, good question. I'll think about that just briefly. So if I were to leave with one thing, it would be it's gonna be like a longer, like not just a one word, but it would be more about develop a disciplined process of investing, just that you could repeat, that you could stick to, and that allows you to filter out the noise. And I know that, and I think the reason why I bring that up now is because I feel like with social media and political cycle and everything else, there's just a ton of noise out there, and you could easily get caught up in the bias of a political perspective, and that matters to a point. But at the end of the day, stocks care about politics, but not to an extent, right? It's ultimately about the fundamentals of these businesses. Now, they could be obviously impacted by regulation or what have you, but ultimately, try to come up with a process that allows you to repeat it. That you can develop rules that you could stick to that allows you to stay invested, and when the market's down in March, and see it through, because that will give you the best opportunity to be successful investing on a longer term basis. But it's important to kind of come up with those things that, it's a personal thing that you could stick to, that your risk tolerance, and then find that little niche and stick to it. That's long-winded, but short-winded thing is, develop rules and have the courage to stick to them. That's the one I would come up with.
Oh, that's great. Yeah, thank you. That's great. And thanks for being here. I appreciate it. I thought we had a really good talk, and I'm sure our listeners will enjoy it. I'm sure of it.
Great. No, I appreciate the conversation. And I'm glad we didn't go down the path of talking about our wives more, else we'd be in trouble. So yeah. I appreciate it. It was a lot of fun.
Yeah, you're right. All right. So, we'll definitely be giving you a call back at some point and inviting you back, because this was very enjoyable. So
sounds good. Appreciate the time, and, best of luck, and hopefully a prosperous 2021.
Oh, thank you. Same to you, Chris. All right. That was a lot of fun. I've never talked to Chris before, and I thought he was really thoughtful and insightful, and I hope he's right. I hope he and I don't get in trouble with our wives. All right. Let's do it. Let's take a look at the mailbag. You know how I'm always saying that I don't want this show to be too political? Because after all, it's a finance show, and some politics is appropriate, but it can get too much real quick, right? Well, maybe you're interested in politics. Maybe you're interested in American and global economics and politics. If so, you're probably going to be pretty excited to know that Trish Regan, the famous finance and political journalist, is now part of the Stansberry team. And Trish Regan has a brand new podcast. It's called American Consequences. You can find it anywhere that you listen to podcasts, iTunes, Google Play, anywhere. Or you can just go straight to AmericanConsequencesPodcast.com. And she's already had some huge names on the show, like billionaire businessman John Catsimatidis and former U.S. Senate candidate Tom Del Beccaro. So check it out. It's available anywhere you listen to podcasts, or just go to AmericanConsequencespodcast.com. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I'm sorry to say, you've finally done it. You've sent me so many long emails that I can't honestly say I've read every word of every email you send me, but I do read as much as I can, and I respond to as many as possible. Hopefully one day I won't even be able to read every single one of them, because it'll just be thousands of them every day. But it's really great. The more you send, the more I have to work with and respond to, and the better the conversation gets. So it's actually good that there's a little bit too much to read. So keep sending them in to feedback@investorhour.com. It's really great what you're doing. The first one this week is from Jonathan A. Jonathan A says, Dear Mr. Ferris, I observed that almost no one anywhere is predicting a decline in equity markets in 2021. No one on Bloomberg Surveillance, no one in the Wall Street Journal, none of the newsletter writers on Stansberry, sure, a few exceptions here and there. And I note that you mentioned 20% cash, not all that much more than that in standard times. I'm not sure exactly what you mean there. But he continues, the contrarian call seems to me to be out or even short of the market, excluding such things as commodity stocks. Your thoughts, Jonathan A. First of all, Jonathan, Steve Sugarud came out, as I speak, he's recently come out with a piece about the melt down. He's been talking about the melt up for a couple of years now, and now he's talking about the melt down. And you certainly are going to hear me talk about the decline in equity markets. I've been talking about it for 3 years, and I'm not going to let up until I get the bear market I'm looking for, man. So there's that. But you're right. By and large, stocks get near all-time highs, and nobody wants to talk about being out of the market or shorting. I think it's more important to be diversified than to try to time the whole market and get your whole portfolio out. Or maybe if you're really that worried, you can try some put options. I've been asked about put options, and I'll talk about that at some point. But I'm not going to talk about it today because I got too much mail to read. But good stuff, Jonathan. Thank you. Next is JFB, who simply says, "Hello, Mr. Ferris. In regards..." Oh, this is the option guy. Okay, so I forgot. I'm dealing with the option question right in the mail. Yeah. "Hello, Mr. Ferris. In regards to the famous option you buy to protect the portfolio downside, could you take us through an example? What product do you use? It would be greatly appreciated. Regards, JFB." So JFB, I'm contractually prohibited from recommending stuff I own and owning stuff that I recommend. Right? So this makes it a little difficult to talk about some of these things. And there are exceptions like gold and Bitcoin and stuff. But I will tell you this. We're just talking about the big indexes, right? So just, there are big ETFs on all the big indexes, and you can buy put options on those. And what I've done is I've got puts that are out 3, 6, 9, 12 months that are, X% out of the money that I think is likely to occur. Some of them are way out of the money, and I just think that the volatility is going to be high enough that it will appreciate, even though the option will never be in the money. And that's really all there is to it. There's not a whole lot. It's not that technical. That's it. And it's not a lot of money either. It's a small amount of money which could appreciate greatly if we get the kind of drawdown that I'm afraid we will. Good question. That's about all I can do for you. Wade S. writes in and says, "Dear Dan, I'd love to hear your opinion on ESG. This is like environmental, social, and governance. It's sort of like socially responsible investing." He continues, "Today I saw another article that some elites divesting in companies that don't meet their uppity standards." Oh, about some elites divesting in companies that don't meet their uppity standards. Swiss National Bank was the latest. Coal is the villain this time. Maybe I'm overreacting, but my natural reaction is between annoyance and disdain. It looks like a bunch of self-righteous virtue signaling. If Stansberry adds a service called ESG Rejects, where we buy profitable businesses sold by the woke, sign me up. That sounds pretty cool, Wade. He continues, "It reminds me of the NYT article about the NASDAQ pushing companies to have diversity quotas for their boards. We're all supposed to admire these elites for their social change. I think their tinkering causes more harm than good. By the way, I used to work in wildland fire, including 5 seasons on a hotshot crew. I subsequently studied forestry in college. Your commentary on the forest fires is astute. I cringe whenever people declare climate change as the culprit. Unfortunately, at least for the federal forest, management or the lack thereof is driven by activist litigation, not science." Wade S. Thank you, Wade. And you know something? That forestry thing, I'm going to keep reiterating it every now and then. And the point is that those of us who either live in these areas and have to deal with, when it snows ash on your front lawn because the fire's 5 miles away, or you can't see across the street, literally, because the smoke is so thick and you got to run the, air conditioning 24/7 because you want to be able to breathe in your own home because you literally can't breathe outside, that kind of thing. Those of us who know that it's not a controversial thing to say it's not climate change, it's the management. We all know this. But it just shows you the times we live in, that every jackass with a stupid viewpoint, and I agree with you on all this stuff, ESG, NASDAQ pushing diversity, climate change affecting the forest fires, you're right, Wade, it's all frickin' baloney. Happy 2021 to you, sir. I'm glad you wrote in. Next comes Bryce B. And Bryce B. says, "I love the podcast, especially the macro-oriented guest. You are a workhorse. I'd say you've earned the right to take a vacation sometime. I guess that applies to almost all of us after this year." Well, thank you, Bryce. And he continues with some stuff. I can't read it all. But then he says, "Since the end of the year is nearing, I have been rebalancing the weight of each category, and he's talking about gold stocks, and would love to hear if there is a specific ratio of bullion, ETFs, minors, juniors, royalties you would recommend to your listeners. I also have a mix of silver stocks. Is there a ratio of gold, silver you follow? Keep on strumming. Thanks, Bryce B. Bryce sounds like a guitar player. Will do, Bryce. I'm determined to play every morning and every afternoon, every day from now on. But no, there's no specific ratio of all those things. I tend to throw around 5 to 10% of your liquid net worth in bullion. But, it's just a ballpark, and really it's a personal thing. And as far as all this other stuff, ETFs, minors, juniors, royalties, to me, maybe except for the ETFs, if they're equity ETFs, that's one thing. If they're bullion ETFs, they're in the bullion category as far as I'm concerned. But if they're all equities, minors, juniors, royalties, ETFs, I would consider them all the same thing. And I would lump it all together and establish that as a percentage of your overall liquid net worth. That's all I got for you. Next comes Robin S. And Robin S. just wants to know, he's holding this stock DDD, one of the 3D printing stocks. And he says, the chief legal officer sold 197,000 shares, then the stock dropped 5%. Is this an automatic signal that things are in trouble, or might he just be taking some profit? Okay, I'm going to stop you right there and answer that question. Insider selling just all by itself is not a sell signal. Insiders sell for all kinds of different reasons. They generally buy in the open market for one reason, because they're bullish on the stock. But they sell for many different reasons. Maybe he is taking profits. Maybe he wants to buy a house, buy a boat, take a vacation, whatever. And then Robin finished up. He says, I am panicking and have tentatively put in a bid to unload most of the stock. Thoughts? Thank you, Robin S. Hey, if you've tentatively put in a bid to unload most of the stock, you've made your decision. And I'm not going to comment on your decision. But I will comment that you appear to know exactly what you want to do. Okay? And there's value in knowing exactly what you want to do. Next comes Wayne B. Wayne says, I've been a Stansberry member and listener for 3 years now. I have cash on the sidelines. When should I reinvest in current investments? Should I keep my portfolio diversification at 3 to 5%, even if the stock is above the suggested buy amount? In a growing portfolio, how should I continue to invest, let alone market swings? I'm in for the long term. I'm 34 years young and have a while to go. Merry Christmas, love the podcast. Oh, Jeff T. I'm sorry, that wasn't Wayne B, that was Jeff T. So, Jeff, generally speaking, the part of this that I'll answer for absolute sure is that generally speaking, you don't rebalance by buying more of something that's gone up a lot. So if, it's over the suggested buy amount or something, I don't know who you're reading, but you generally rebalance by selling what's gone up and buying what's gone down. Now, buying what's gone down can be difficult for a lot of people because they tend to sort of buy and buy and buy all the way to the bottom. So in the context of maybe using trailing stops, you could say, well, I'm going to, use trailing stops to completely exit a position. But short of that, if I get to the end of the year and something has fallen and I'm not stopped out, maybe I'll rebalance a little bit. Or what might work better, you have to think all this out for yourself, by the way. What might work better is you could say, look, I start out with a 3 to 5% allocation, and then that's it. No rebalancing. Because, for example, what if you took our advice years ago to buy Constellation Brands back in 2011 or something, that thing just went up and up and up, and eventually it was like a 10-bagger. You don't want to sell that down and rebalance it, right? And I heard a story, one of the great all-time stories is about the coffee can portfolio, where the guy just bought $1,000 or $5,000 of every stock that was recommended to him by the firm that was managing his and his wife's, that was consulting with him and his wife, basically. And his wife followed the buy and sell advice of the firm. The husband never sold anything, and he made 10 times more money. And so he never rebalanced or sold anything. He just bought, and the stuff that went down, and the stuff that went up so much over decades and decades that he made tons of money. So I'll just share that with you. And, I can't really tell you what to do because it's the advice here would be too general. Okay, so now comes Wayne B. Wayne B says, "Hi, Dan, longtime Stansberry client. Really enjoy your podcast. Recently, you've been emphasizing the most important thing investors have in common is risk management. Can you recommend a book?" Okay, yes. It's called The Most Important Thing by Howard Marks. And The Most Important Thing has like 18 chapters on all these different things. And the one topic that takes up 3 chapters is risk. Read those 3 chapters on risk before you read anything else, Wayne. That's my advice. Next is Al M. And Al, I love your emails. I can't read it all, but see if I can sum this up and then get to your question here. Or maybe I'll just go straight to the question. Looking at the current situation in the stock market, considering the work of John Hussman, Lacey Hunt, etc., and all developed nations' debt, is it really possible that this turns out well? The politicians will destroy their poor constituency, even if their inflation plan works. This is simply amazing how society could be so foolish. You know, it's a mixed bag, isn't it, Al? Because over time, humanity moves forward. We do well over time. But in short periods of time, we can have wars and inflation and all kinds of things. I don't think we wind up in a hellscape, an apocalyptic hellscape or anything, even economically for very long. But, we're going to see bear markets. We're going to see inflations. Yeah, if you don't prepare for those things, I think you're screwed. Period. It's a good question. Is there any way all this, enormous multi-trillion-dollar deficits and Fed just printing and buying and printing and buying and printing and buying and all of this stuff works? No, over time it's foolish. It's wrong. Last comes Lila J this week, and she says, "Hi, Dan. I'm a paid-up subscriber of several Stansberry products. I've been a regular listener of the Stansberry Investor Hour for a couple years. I'm writing to let you know I've really enjoyed this last year of Stansberry Investor Hour. You have obviously put in a lot of time and research in selecting which speakers to interview. I look forward to each new episode and absorbing different insight and perspective that your show offers. Consequently, your show has helped me develop into a more well-rounded investor." Yay! Triumph! That is the mission of the Stansberry Investor Hour, to help our listeners become better investors. Thank you, Lila, for writing in. And she finishes up, "As a result, all of my portfolios that I manage have more than doubled during the past year." That's all on you, Lila. Good for you. She says, "I just want to thank you for the diversity that you bring to the show each week, and I wanted you to know that your hard work is recognized and appreciated. Best regards in 2021. And to you, Lila, thank you very much." That's it for another mailbag, and that's it for another episode of the Stansberry Investor Hour. Hope you enjoyed it as much as I did. If you want to hear more from Stansberry Research, check out AmericanConsequences.com/podcast. Do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. Also follow us on Twitter, where our handle is @investor_hour. If you have a guest you want me to interview, drop me a note at feedback@investorhour.com. Till next week, I'm Dan Ferris. Have a happy 2021, and thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.